Draw 4% out of the median retirement account of an American household aged 65 to 74, and it pays you $667 a month. Before taxes. That is the check that has to cover the next 30 years of your life, and if it is short, the bill comes due as cut spending, a job you did not want at 70, or a Social Security check you claim early and shrink for good. Not a savings failure. Not one bad decade in the market. A handoff. In 1978, a technical clause buried inside a tax bill moved the entire risk of your old age off a corporate balance sheet and onto your kitchen table. Nobody sent you a letter. That is the villain in this video. And it has a name. The risk transfer. In plain English, the company stopped carrying the outcome, and you started. The number behind it is $200,000, and the Federal Reserve counts only the households that have a retirement account at all. If your father retired on a company pension, he never had to know that number. Somebody else knew it for him. In 1975, 27 million private sector American workers were covered by a pension that promised them a check for life, and only 11 million were in the kind of account you have, a pot of money sitting in your own name. The company carried the risk. If the market fell, that was the company's problem. If you lived to 96, that was the company's problem too. In the March 2025 federal data, 14% of private industry workers still have access to a plan like that. 14. And this is not a one-time shortfall you can absorb in a bad year. It is a monthly problem, and every risk the company used to absorb is now yours, at 80, at 90, in whatever market you happen to get. So here is the sentence to keep. Your retirement account is not a small pension. It is a pension with the guarantees stripped out and the risks handed to you. In the next 15 minutes, you will see which 4 risks now sit on your kitchen table, which 3 of them you can still buy back, and what each one costs. Take the 4 risks right now because they are the spine of everything that follows. Markets, longevity, contributions, timing. A pension absorbed all 4 of them for you. Your account absorbs none of them. And the 4th one, timing, is the one almost nobody plans for, because it is the one that decides you rather than the other way around. Quick favor before we start the clock. If this is the kind of history nobody ever walked you through, tap like and subscribe now so the next breakdown reaches you. To understand why your $200,000 has to do so much work, start in 1934. There was no Social Security. There was no company pension for most people. If you were old, you could not work, and your family could not carry you. One institution was left, and nearly every county had one. The poorhouse. It was not a metaphor. It was a building. In some states, accepting relief could cost you your personal property, your right to vote, and your right to move freely. In some places, you were required to wear a large letter P on your clothing. The unpleasantness was deliberate. By 1934, the government's own estimate was that more than half of older Americans did not have enough income to support themselves. Not a bad retirement. No retirement. Old age was not a stage of life you planned for. It was a risk you survived, or you did not. 30 states had scraped together some form of old age pension by 1935, and most paid almost nothing. That is the country that decided it needed a federal answer. August 14, 1935. The Social Security Act. Look at what it was designed to do, because this is where most of the confusion in your retirement begins. It was built as a floor. Not a plan. A floor is what stops you falling into the poorhouse. It was never engineered to be the whole retirement plan for most households, and that has never changed. Now look at what happened around that floor over 90 years. The Social Security Administration's own figures say that roughly half of Americans 65 and older get 50% or more of their total income from that single monthly check. about 1 in 4 get 90% or more. A program built as the last line of defense became, for a quarter of American retirees, almost the entire defense. That did not happen mainly because Social Security got more generous. It happened because so much of what was supposed to sit on top of it went away. For roughly 40 years after the war, the middle of the American economy ran on a promise called a defined benefit pension, and its mechanics are the exact opposite of what you have now. You did not pick investments. You did not pick a contribution rate. You did not have a balance to watch. You had a formula, years of service, times a percentage, times your final salary, and it produced a monthly check that arrived until you died. Live to 100, and the checks kept coming. That is the whole story. The employer carried market risk. The employer carried longevity risk. Your job was to show up for 30 years. Then people found out what the promise was worth when the company was in trouble. In 1963, Studebaker closed its plant in South Bend, Indiana, and terminated its pension plan. Thousands of workers lost some or all of what they had been promised. Those already retired were paid in full. Roughly 4,000 active workers, men with decades on the line, received about 15% of what they had earned. The ones under 40 received nothing at all. The promise was only as good as the company behind it, and no law at the time made sure the money was there. That took 11 years to fix. September 2nd, 1974. President Ford signs the Employee Retirement Income Security Act. ERISA. If you have ever seen that word on a plan document and skipped past it, that is the law that came out of South Bend. ERISA did 3 things that still protect you. Minimum funding rules, so a company could not promise a pension and quietly fail to fund it. Vesting rules, so your benefit became legally yours after a defined period instead of evaporating when you left. And the Pension Benefit Guaranty Corporation, a federal backstop that pays your pension, up to a legal limit, if the plan fails. This is the part almost everyone gets backwards. ERISA was not the end of the pension. ERISA was the rescue of the pension. 1974 is the high watermark of protection for the American worker. 4 years later, the ground moved. The Revenue Act of 1978, a tax bill. Buried inside it, a technical provision that became Section 401, Paragraph K, of the Internal Revenue Code. It was not written as a replacement for your pension. It described a cash or deferred arrangement, a way to take part of your pay and defer it into a retirement account, a supplement sitting on top of the pension you already had. Here is why it spread so fast, and it has almost nothing to do with what is better for you. A defined benefit pension is a liability. It sits on the company's books as a promise it must fund decade after decade, on the hook if markets disappoint or if its retirees outlive the actuary's assumption. A 401k is a payroll expense. The company contributes what it contributes this year, and it is finished. No promise, no liability, no exposure to how long anybody lives. From the employer's side, this was not only a cost cut, it was the risk transfer. Every uncertainty a pension used to absorb still exists. Markets still fall. People still live to 95. Those risks did not disappear. They changed owners. The Department of Labor's own historical tables show the handoff happening. Active participation in private defined benefit plans has been falling since 1984. By 1997, more money sat in defined contribution accounts than in traditional pensions. And in the March 2025 federal data, 70% of private industry workers had access to an account like yours. 14% had access to a pension. 50 years, start to finish, and it was never announced. Put real weight on those 4 risks now, because being responsible for your own retirement is not a slogan. It is a list of 4 specific jobs that used to belong to somebody else. Risk 1. Market risk. What your retirement is worth depends on what stocks and bonds did while you were working, and even more on what they do in the first few years after your last paycheck. A pension paid the same monthly amount whether you retired into 1999 or into 2008. Risk 2. Longevity risk. A pension check does not know how long you will live and does not care. Your balance cares enormously. Nobody can hand you the correct withdrawal rate for a life whose length nobody knows. Risk 3. Contribution risk, and this is the quiet one. Under a pension, saving was not a decision you made every year. It happened because you were employed. Under your system, every year you put in less than you should have is a year that is now permanently behind you. Risk 4. Timing risk, and this is the one I flagged at the top. The Employee Benefit Research Institute's 2026 survey found that workers expect to retire at a median age of 65, while retirees actually stopped at a median age of 62, with nearly half saying they left earlier than they had planned. Layoffs. Health. A spouse who needed care. 3 years you were counting on to save and not to spend, taken out of your hands. So test your own plan against it. If the arithmetic only works when you retire exactly at 65, that is not a plan. That is a guess with a date on it. 4 risks. A pension absorbed all 4 of them. Your account absorbs none of them for you. That is the whole trade, and nobody signed it. So the only question left in your retirement plan is which of the 4 you buy back first. Which brings us back to the number this ARC produced. The widest measure we have is the Survey of Consumer Finances, the study our central bank runs every 3 years, because it counts everything a household holds across every retirement account. In its 2022 data, the median household aged 65 to 74 held $200,000. 2 things about that figure, and both cut the same direction. First, it is the median among households that have a retirement account at all. 54% of American families in that same survey. The households with nothing are not inside that number. Second, run it. $200,000 at 4% is $8,000 a year. $667 a month before taxes for a household that has to fund 30 years. And the narrower measuring stick is harsher. This one is not households, it is single workplace accounts, a different count of a different thing. Vanguard administers about 5 million of them, and its 2026 report puts the median balance for participants 65 or older at $103,202. At the same 4%, that one account pays about $340 a month. That is what the risk transfer produced, not a catastrophe for everybody, but a system where the median result is a few $100s a month sitting on top of a check that was designed to be a floor. So what do you do with this, 5 years out or already out? You buy back the pieces of the old system that are still for sale. There are 3. 1. For most people watching, the only pension-shaped check left is Social Security. If you're one of the 14% with a real pension, or a government or union plan, you're holding 2. And the same logic applies to both. Under current law, Social Security pays for life, it adjusts with inflation, and it cannot be outlived. Every year, you delay claiming past your full retirement age adds 8%, up to age 70. For someone whose full retirement age is 67, which is anyone born in 1960 or later, a benefit claimed at 62 pays 70% of the full amount, and one claimed at 70 pays 124%. That is roughly 77% more, permanently. For a healthy retiree who can afford to wait, nothing sold on the open market rebuilds a pension that cheaply. 2. Sequence risk belongs to you now, so hold cash the way a pension held bonds. The first few years of withdrawals decide the ending. This is about near-term withdrawal money only, not the whole portfolio. The specific dollars you already know you will spend in the next 2 or 3 years should not be sitting in a market that can fall 30% while you draw from it. 3. Decide which risk actually frightens you, because the 2 answers are different. If your fear is outliving the money, the fix is more guaranteed lifetime income, a delayed Social Security benefit, or a plain income annuity, meaning the simple kind that takes a lump sum and pays a set monthly check for life, not the products with market features and riders bolted on. 2 warnings on that one. It is only as good as the insurer standing behind it, and you generally give up access to the lump sum, so it is never money you may need in an emergency. If your fear is simply running short of spending money in a bad year, the fix is a withdrawal rule you will genuinely follow. 2 different problems, 2 different tools. Here is the honest version. You were not careless. You were handed a job in 1978 that used to belong to an actuary, a trustee, and a corporate balance sheet, with no title, no budget, and no warning. The people who ran the old system had mortality tables and a legal funding requirement. You had a fund menu and a default contribution rate somebody else picked. Knowing that does not fix it. It tells you where to aim first. Once you can see which 4 risks moved onto your side of the table, you can price each one and cover the ones that would genuinely break you. Do one thing this week. Log into your Social Security account and read the 3 numbers side by side, what you receive at 62, at your full retirement age, and at 70. For most households, that is the pension. Its size is still a decision you control, and it is the last guaranteed floor you can still make bigger. None of this is a recommendation for your household. This is education, not financial advice, and not legal advice. Sit down with a fiduciary and run your own real numbers before you move a dollar, because the 4 risks land differently on every kitchen table. If this arc explained something the last 40 years never did, tap like so more people your age see it, and subscribe for the rest of the series. And in the comments, type the word pension if you want the follow-up on turning a balance into a paycheck. You inherited a pension with the guarantees stripped out. The work left in front of you is buying back the guarantees that matter most.